All right, welcome back to a second part of depreciation. We're going to be taking a look at another costing method called double declining. Okay, so I've mentioned I mentioned to you that when we do depreciation, you have to have all 5 of these components, right? You need to know the cost of the asset, the estimated useful life or the units that it could produce, a salvage value, and then date that you placed into service. Okay, and today, the date that you place into service is very important. And also, you need to know what depreciation method that you're working on. So, like I've mentioned before, right? There are 3 that I'm going to teach you today. So, we already covered the first one, which is activity based, which is units of production. So, today we're going to go over double declining or accelerated depreciation. Okay? So, double declining method. What is the purpose of using the double declining method? So, in this case, right, when you depreciate your fixed asset, normally you are more likely to use it more frequently in the beginning of the years versus towards the end of the year, right? So, for instance, a laptop per se, right? You go to school. You're going to be probably using that laptop majority of your life because you're in school. But as soon as you finish school, maybe you don't use it that much, right? Give or take, let's say schooling is about like 4 years. You end up not using it as much, okay? Unless it's work related. But other than that, you're least likely to use your laptop after you've already went through 4 years of school. That's just an example. Where your laptop, you had to use it the most in the very beginning of its life, but as soon as you graduate or you finish school, you don't use it as much. Okay? So in this case, right, we all know that we use our phones so much, right? So that's the same idea too, is that you get a brand new phone, you're more likely to use it more frequently than you are normally towards the end of its life, right? Because it gets slower, okay? You get frustrated over the technology, right? Maybe it's not clear, okay? So in that kind of case, we are going to be using double declining method, where because we're using it more frequently in the beginning of its life, you are going to depreciate it twice as much, hence the word double declining. Okay? So in this case, here's the formulas for double declining. Okay? First one is your depreciation basis is going to be your beginning of the year's book value. Okay? Beginning of the year's book value. That means every year your depreciation basis is different. Okay? And then your depreciation rate is going to be 1 divided by the number of estimated useful life times 2. Because why? You are declining it twice as fast. Okay? So like the 1, like a regular number 1, and you're dividing it amongst the number of useful life, and you're multiplying it by 2. Depreciation basis is going to be, depreciation expense is going to be basis times rate. And then your 2 other formulas will stay the same, right? The accumulated depreciation is your previous year plus your current year's depreciation expense. And your book value is going to be your asset cost minus your accumulated. Okay? So the last 2 stay the same. Okay? So here we're going to have a different basis, a different rate, and the expenses basis times rate. Okay. So here, let's take a look at an example where you bought a machine worth $15,000 and you have a salvage value of $2,500. Estimated useful life is 5 years, and the number of units that it could produce is 10,000. And the date that you placed into service was January 1st. So in this case, how do I solve for my depreciation basis for the first year? Well, we know that basis is going to be the beginning of the year's book value. What does that even mean? In this case, right, when you are going to be looking at book value, right, we know that we have to calculate book value by taking your asset cost minus your accumulated depreciation, right? In this case, since it's the very first year, your asset cost is $15,000 and you don't have any accumulated depreciation, right? So in this case, for the very first year, your beginning of the year book value is your asset cost, right? Because you haven't depreciated at all. So that means $15,000 is what you're going to begin with. Okay? Now you need to solve for the rate. Rate's going to be 1 divided by the estimated useful life. So in this case, we have 5 years of its life, right? So 1 divided by 5, okay? If you calculate that, that gives you 20%, but you have to multiply it by 2 because you are double declining it. So in this case, you're going to depreciate it. 0.2 times 2 is going to give you 0.4, or also known as 40%. So you're going to depreciate the asset 40%. So in this case, the depreciation expense is going to be basis times rate. So in this case, we're going to take 15,000 and we're going to multiply that by 0.4. And that's going to give you $6,000. Okay? So let's calculate it. Your accumulated depreciation is going to be your previous year's accumulation, which there isn't any, plus the current year's depreciation expense of $6,000. So therefore, it's going to be $6,000. So then what is the book value at the end of year 1? Well, let's calculate it. Your asset cost of $15,000 minus your accumulated of $6,000, it's going to give you $9,000. Okay? All right? So then, how do we solve for year 2? Well, let's see. Year 2. I need to know what my depreciation basis is, which is the beginning of the year's book value. So in this case, right, if you ended year 1 as of December 31st, right, your ending book value will become your book value for the beginning of the year, right? If it's December 31st and it's valued at $9,000, that means January 1st, what is it going to be valued at? $9,000. So in this case, that's exactly what you're going to do. You're going to plug in the book value that you solved at the end of the year of year 1 because it becomes the beginning of year 2. Okay? Then you're going to have to solve all over again. What's the depreciation rate? Well, it's 1 divided by 5 times 2, which in this case is 40%. So we're going to take 9,000, multiply by the 40%, and you're going to get 3,600. So then you're going to add that to your 6,000 because that's your previous years. You're going to get a total of 9,600. So then you solve again. You're going to solve right here that the book value is going to be your asset cost of $15,000 minus 9,600. Your answer is going to be 5,400. Okay? And then you're going to repeat that with year number 3, carry it over to year 3, and then take 40% of that, and so on and so forth. So therefore, excuse me, you're going to notice this. By the time it reaches 4th year, book value falls below salvage value. And remember that rule. We can never let book value fall below salvage value. So in this case, it went below by 1,944. How much was I supposed to have it for? 2,500, right? right? As of year 4, I'm supposed to have a salvage value that is supposed to be 2,500. In this case, I fell way below it, right? I'm at 1,944. So what do I do here? Since my book value fell below salvage value, what do I need to do here? In this case, you need to work backwards, because at least we can identify this, right? If the 4th year, okay, assuming this, because you're depreciating it twice as fast, that means it's not going to last you the life, it's not going to last you for the entirety of its life. So in this case, we know at least one thing. At the end of its life, so in this case it ended in 4 years, my book value must equal salvage value. That's the least that we know, right? So in this case, we know at the end of the year, my book value should equal salvage value. So therefore, it should be 2,500. Now, because of this, we need to work backwards, okay? We have the numbers that we have to be able to work backwards, right? Because the formula for book value is your cost of the asset minus your accumulated. So in this case, right, in order to solve for the accumulated depreciation, you're going to work backwards, because if you already know what book value is, which is 2,500, and you already know that the cost of the asset is 15,000, you just simply move your problems around or your variables around to solve for it. Well, what makes sense, right? What's 15,000 minus X equals 2,500? Should give you 12,500, right? Then you gotta work one more step backwards, because now I need to know what my depreciation expense is. Well, let's figure it out, because you're given this much information, right? You're given that your accumulated depreciation is going to equal your previous year's accumulated depreciation plus current year's depreciation expense. So in this case, you know what your accumulated depreciation is, you know what your previous year's accumulated depreciation is, and you're solving for the current year's depreciation expense. So if I have an equal of 12,500 is equal to 11,760 plus X, solve backwards, right? How do you get to 12,500? If you have 11,760, you can subtract the two numbers, and you're going to solve that. Your depreciation expense is going to be for $740. So in this case, that's what you have to do. When your book value falls below salvage value, you're going to have to work backwards, because this is the proper way to go ahead and depreciate your asset, is that you're going to rewrite it and say, I need to depreciate it for $740 opposed to the previous one, right? And then you're done with your asset. Okay? So any questions here? Okay. So as I said before, right, double declining doesn't guarantee that the asset will last for its full 5 years. Because you're depreciating it twice as fast, think about it. If a machine is supposed to last you X amount of years, but you're running it to the ground twice as fast, do you expect that machine to last you? So in this case, that's exactly why for this exact scenario, we end up not depreciating it for the full 5 years, because we're depreciating it twice as fast. Okay? So as I remember, so here, my book value has become my beginning of the year book value or my depreciation basis every year. Okay? The rate stays the same. So at least you know that, because it's always going to be 1 over divided by the estimated useful life times 2. And then, of course, your depreciation expense is going to be based on your basis times rate. And then at the end, your book value at the end of the year is going to be your salvage value. Okay? That is a must. A must. Okay? So how do I depreciate? How do I journalize my adjustment? It's going to be the exact same journal. Only difference is, because of the way that you're calculating things, that is what's going to be different, is your debits and credits. So in this case, you're still going to have your depreciation expense, and you're still going to have your accumulated depreciation. Only difference is, because the way that you calculate it, your depreciation for the first year is going to be $6,000, right? Right? $6,000. And then for the second year, it's whatever you calculated in here. For the second year, it was $3,600, right? So everything's the same. Only difference is the number that you calculated is different, okay? So then, what happens when you occur partial years? Because it depends on how you depreciate your fixed assets, right? Do you depreciate it every month, or do you depreciate it at the end of the year? Most common, usually you would do it at the end of the year. So if you do come across of going through partial years, because you're going to be depreciated at the end of the year, assuming it's calendar year, then you need to calculate how much of your assets you're actually using. So in this case, here's another example where you purchased a machine on October 1st, okay, for $10,000. Its estimated useful life is 5 years. It can produce up to 25,000 units, and it has a salvage value of $2,500 at the end of its life. Okay, and the machine was put into service on October 14. Record the depreciation. So in this case, excuse me, if I put the machine in service as of October 14, what is that going to tell me? That means, well, if I put it on the 14th, I used it for majority of the month of October, right? It was before the 15 days. So in this case, I have to start depreciating as of October. And then, because if I'm doing my depreciation adjustment entries at the end of the year, assuming it's December 31st, I used it for October, November, and December. So that's 3 whole months that I'm using it for. So therefore, for my very first year of depreciation, right, because I'm depreciating at the end of the year, December 31st, but I only use my asset for October, November, and December. I only use it for 3 months. So how do I put this in here into my books? Well, first thing I gotta do is determine my depreciation basis, right? So we already know it's gonna be your beginning of the year book value, which is going to be your asset cost minus your accumulated. In this case, there is no accumulated depreciation because you're starting your depreciation now. So it's going to end up being your asset cost. So in this case, $10,000. You're going to figure out what your rate is, which is at 1 divided by the estimated useful life of 5 times 2, right? So 20% times 2 makes it 40%. So in this case, I'm going to calculate it right now. Basis times rate. So 10,000 times 40% is going to be $4,000. Now in this case, that is for the whole year. Is it true that I can depreciate my whole asset for the whole year?
Yes.
Well, how old is your asset?
It's 3 months.
So in this terms, right? So if you're gonna treat your asset like it's your baby, right? If your baby is only 3 months old, can you call it 1 year old?
No.
No. You have to adjust this number because when we depreciate it, right? It's only been used for 3 months. You cannot depreciate it for the whole year. Okay? So in this case, that means I need to adjust this $4,000 expense because if I'm doing it at the end of the year, assuming December 31st, I only use my asset for 3 months. So therefore, I need to change this number. So I have to figure out, right? If I only used it for 3 months out of one whole year, right? So that's 3 out of 12 months, which is also known as 25%, okay, or 1/4. So in this case, right, if I only used it for 1/4 of a year, 1/4 times that $4,000 is going to give you $1,000. And that's your depreciation expense for the first year because you can't depreciate it for a whole year. You can only depreciate it for a partial of the year, hence the word partial year. So that's why it's very important to know because in this case, right, double declining is time sensitive, right? We're using the life of the asset to determine to spread the cost amongst the life of the asset, right? It's based on time, so it's very time sensitive. So in this case, you'd never want to treat your 3 month asset as if it was 1 year old, right? You have to treat it like it's 3 months. So in this case, you're going to adjust your number accordingly. Okay? So of course, when you journalize it, same journal is going to be depreciation expense and the accumulated depreciation, but this time it's only for $1,000. Okay? So chapter review, since we already reviewed all of the components of depreciation yesterday, this section is only looking at calculations. Okay? So here's the formulas that you need to know. Okay? This is going forward. Now, what happens when your book value falls below salvage value? Then you're going to have to work backwards 3 formulas. Okay? And of course, the double declining is going to be where you use it majority of the beginning of its life and you're depreciating it twice as much. And you always have to keep an eye. Does your book value, if it falls below salvage value, then you have to fix it, right? So you have to basically make sure that at the end of its life, your book value will always equal salvage value. Okay? So make sure you have these formulas on hand, and let's go ahead and dive into the very first exercise here. So 11.2, double declining method, okay? And we are looking at number 1, that you purchased a cash register for $300, okay, with no salvage value. And its estimated useful life is 5 years, and it can print up to 5,000 receipts. Okay? And you put this cash register in service on January 8th. So, number 1, what did I buy?
Cash register.
We bought a cash register. Okay? How much did it cost me?
$300.
$300. What was my salvage value?
No, nothing.
Yep, you don't have a salvage value, right? What's my estimated useful life?
5 years.
You got 5 years on this machine. And When did you place it in service?
January 8th.
January 8th. So what does that tell me? When do I actually start depreciating this asset?
It's going to be from the 1st of January to the end of December.
Correct. So that means I am going to depreciate it for 1 whole year. Okay? So for the first year, okay, what's my depreciation basis?
300.
300, right? Because it's going to be your book value, beginning of the year book value. So in this case, asset cost minus accumulated depreciation. We don't have an accumulated depreciation. We're starting our depreciation. So therefore, it's going to be equal to your asset cost for the first year. What's my depreciation rate going to be?
40%.
40%, right? Because it's going to be 1 divided by the number of estimated useful life of 5 years, right? Multiplied by 2, because it's 20%, right? 1 divided by 5 is 20%, times 2 is 40%, okay? So, in this case, for the first year, what is my depreciation expense?
I got $120.
$120. Excuse me. So therefore, what's my accumulated depreciation?
Nothing, right?
In this case, you don't have an accumulated depreciation or previous accumulated depreciation, but you do have a current year's depreciation expense. You used the machine, right? You used it and you depreciated it by $120.
So it'd be 420.
That's the book value.
Okay.
So the accumulated depreciation, how much depreciation did you rack up? That is what the accumulated depreciation is. How much did you use the machine? Well, in this case, you didn't have a previous year's, but you did use the machine for $120, right?
Mm-hmm.
So, in this case, my book value is going to be my asset cost minus my accumulated depreciation, which gives me $180. Okay? Because if I started at $300 and I used $120 of it, how much should I actually have left?
180.
180. Okay? So, let's solve for the second one. What's my depreciation basis for year 2?
180.
180, right? Because the end of the year, if my book value was 180, that becomes my beginning of the year for the second year. So in this case, 180. What's my rate going to be?
40%.
Good, right? 1 divided by 5 times 2 gives you 40%. So what's my depreciation expense going to be?
$72.
You're going to depreciate it by $72. So therefore, what is my grand total of depreciation I've collected so far? So what's your previous year's accumulated depreciation?
Is it 108?
Not 108. Accumulated depreciation means how much in grand total depreciation have you collected. So in this case, what's my previous year? How much did I use my machine from the previous year?
That's 300.
No. What was my previous year? How much did I use my machine for?
Okay, $120.
$120, right? What did I
Right.
use it this year?
72.
72. So what's my grand total that I depreciated my asset for?
$192.
$192. So therefore, how do I solve for my book value?
Would it be 192 minus 300? 300 minus 192.
Excellent, right? Because I'm going to start all over from the very beginning, right? How much did
Right.
my assets start with? It started with $300. How much did I use it in grand total between the 2 years? 192. So in this case, what is my book value? So
108.
108. So you did answer that for the book value. Okay, 108. So let's move on to the third year. What's my depreciation basis?
108.
108. Okay, what's my rate going to be?
40%.
40%. So in this case, we already know it's going to be 40% for every single year. So what is my depreciation expense going to be for year 3?
$43.20.
$43.20. So now I need to figure out what my accumulated is. So if I have, as of year 2, a grand total of 192, I need to add what I did for this year. So what's my accumulated depreciation?
$235.20.
$235.20. So therefore, what is my book value going to be?
Is it 64.80?
64.80. So, fourth year,
64.80.
64.80 times 40%.
$25.92.
$25.92, giving me an accumulated depreciation of
$261.12.
$261.12, giving me a total book value to be
$38.88.
$38.88. Good, which becomes my book value for year 5. Okay, what's 40% of 38.80?
$15.55.
Mm-hmm. Giving me an accumulated depreciation of
$276.67.
mm-hmm. Giving me a book value of
$292.22.
not $292.22. How do you solve for your book value?
Oh, 23.33.
$23.33. Now, can I keep going?
No.
Good, right? You shouldn't, because at the end of the day, right? What did I buy?
Uh, and a cash register for 300.
Okay. Now, at the end of its useful life of 5 years, it still has a book value worth $23.33. Now, realistically, do you think you can resell a used cash register that you used for 5 years?
No.
No. You're most likely going to dispose this asset. Now, at the end of its 5 years, what can happen to a cash register? Right? The receipt roller doesn't work properly. Maybe the buttons are faded. You can't see the buttons anymore. Maybe the cashback register or open register, you have to push really hard on it, and it will, or maybe the spring in there is broken. Many things can happen because in this case, this is technology. Maybe the screen doesn't work anymore. There's many things that can happen, especially if you have an asset that's being used either that much and it's no longer beneficial for you to keep using it, right? Maybe, like I said, maybe the buttons don't work anymore. Okay? So there are many, many reasons why you shouldn't continue its life. Even though the number one rule is we haven't met salvage value yet. It's not zero. But let's really think about it in real life. Is it worth it to continue to depreciate your register? At this point, you got broken buttons, you got a receipt tape that doesn't print out properly, your cash drawer, your open drawer doesn't work because the spring is broken. In this case, is $23 even worth it?
No.
No. You're better off investing into a newer machine, right?
Right.
So in this case, this is the decision that you have to make. If it's still in good condition, then I say why not? Use it for another year, okay? But if it's already at the end of its life and it's already really worn and torn out, you definitely are better off not pushing this machine through and getting a new one, okay? Especially because technology, it does not last that long, right? We already know that technology does not last long at all, right? A standard laptop only lasts maybe a person 2 or even 3 years at most, right? Because technology doesn't last long anymore, okay? So let's go ahead and practice journalizing this, right? We're going to practice journalizing our adjustment entries for the first and second year. So, assuming that I am depreciating at the end of the year, December 31st, how do I journalize my transaction? How do I do my adjustment?
Depreciation expense.
Depreciation expense. Okay. Okay. For the first year, how much?
$120.
$120 for the first year. What about then? What's my credit going to be?
Accumulated depreciation.
Mm-hmm. What about how do I journalize my adjustment entry for the second year?
Okay, it would be depreciation expense.
Good. For how much?
$72.
Yep. We'd appreciate it for $72 the second year. Okay. Good. Any questions so far?
No.
All right, let's go ahead and do exercise, the second exercise here. So, number 4, okay? If you decide to purchase a computer for $1,988, okay? This includes all fees with a salvage value of $200, okay? Now, in this case, its estimated useful life is 5 years, and you put this machine into service as of August 25th. Assume that you are doing your adjustment entries at the end of the year, okay, December 31st. So in this case, what did I buy?
A computer.
You bought a computer, right? How much did you buy your computer for?
$1,988.
Good, $1,988. How much is your salvage value?
$200.
$200. Estimated useful life?
5 years.
When did you place into service?
August 25th.
So what does that tell me? When do I actually start depreciating it?
September.
Starting September. Now, if you're depreciating at the end of the year, assuming December 31st, how old is your asset going to be? Excuse me.
4 months.
Good, right? So the first year, you have to keep in mind 4 months. Right? So let's go ahead and determine what is my depreciation basis.
It's 1,988.
Good, right? It's going to be your asset cost. Right? What's my rate going to be?
It's going to be 33333.
How did you get 3333333?
Because we only have like 4 months of service on the computer.
Okay, but that's not the same as the rate. What is my rate going to be? That's how many months I need to adjust my expense, but that's not my rate.
Okay. It's going to be 40%.
So 1 divided by 5 times 2 is 40%. So now, okay, what's my depreciation expense?
$795.20.
Now, is that true? Can I depreciate my asset for $795.20?
No,
No, because that's for the whole year. Is my asset 1 year old right now?
no,
How old is it?
it's 4 months old.
It's only 4 months. So in this case, I need to take this 795.20, and I need to adjust it because my asset's only 4 months old. So you solve for 0.33333, right? So that's 1/3 of a year. So how much is your depreciation expense if your asset's only 4 months old?
Hmm. $662.66.
You're not subtracting 33. Think about it. If one whole year is going to be $795, right?
Right.
How do I figure out a portion of that year? You already know that it's 4 months old, right?
Right. Well, what I did is the 1,988 times that 0.3333, and I come with 662.66.
Now remember,
Is it 1,057?
no. Okay, let's start over. Okay? If I know this much information, right?
Right.
If one whole year I will depreciate it by, it's going to be $795.20. But that's for a whole year. Now what you did was you multiplied it by the 33, right?
Right.
That only gave you how much the asset is going to be divided by 3 years. That's not what we're doing here.
Okay. Let's try one more time. Is it 198.80?
198.80. No.
No.
Okay. How did I get $265.02? Well, that's what I'm trying to say, okay? So in this case, let's redo the whole thing again, okay? If I know my entire year for depreciating my asset is going to give me $795.20, right?
Right.
Okay. Yes, Norman.
Yeah, I got 262.
Okay, so in this case, right, we have $795.20, right? Now, if I were to divide this into months, how much is it going to cost me per month?
It's going to be one, well, if you divide it by the amount, which is 4 months.
No, I'm not asking you that. I'm asking you to tell me how much is it going to cost me per month? if I started with $795, that's for one whole year. Convert this in terms of months. How much is it going to cost me per month?
$265.
No, that's for the 4 months. So
would it be? Is it the 0.3333?
no,
No.
okay. For the whole year, it costs me a total $795.20. How do I determine how much it's going to cost me per month?
Divided by 12.
Divided by 12. Go ahead,
Okay.
divide $795 by 12.
66.5.
66.27. Okay, no rounding here. You're not taking 795, you're taking 795 and 20 cents. Okay? So $66.27 per month. Now, how many months did I use?
4 months.
So you take the 66.27 times 4, and what do you get?
265.08.
265.07 in this case. Okay? Now, is that true? Well, let's see. So if I do my calculation, right? This is how I figure it out without having to go too many steps, okay? If I already know that to depreciate it for one whole year, because remember, this is the estimated useful life. It only has 5 years, right? So
Right.
I'm dividing it by 5 years because I want to know how much I need to depreciate for one whole year. So in this case, that's that number here. But my asset's not one whole year. It's only 4 months old. So in this case, what I do here is I multiply by 4 and divide the whole thing by 12. Why? Because it's only 4 months old out of 12. Right?
Right.
So in this case, I get that 265.07. Okay, do you understand? From down below, how did I solve for that? Well, if I divide the whole thing by 795.20, and I divide that by 12, that gave me $66.27. I have it for 4 years, so therefore, it gave me 265.07. Yes? Okay. So, if that's the case, then what's my accumulated depreciation for the first year?
265.07.
265.07. So what is my book value going to be?
$1,722.93.
Okay. 1722.93. Okay. So then, how do I solve for my basis for year 2?
It would be you would put the basis for 1722.93.
1792. Good. What's my rate going to be?
40%.
40%. Now, in this case, if I put my asset into service as of September, right? Or that's when I start depreciating it, right? If I'm starting on the new year of January 1st and I'm depreciating it for a whole year for the second year, my calculation is going to be straightforward. because in this case, I already calculated my partial years in the very beginning. Now, if I'm depreciating it for a whole year now, from January all the way to December 31st. So in this case, what is my depreciation expense for the second year?
$689.17.
Okay, 689 and 689.17. All right, good. So then what's my accumulated depreciation?
$954.24.
Okay, good. So therefore, what is going to be my book value at the end of year 2?
$1,033.75.
1,033.76.
6.
So you're let me see. If it's 15, what is it? No, 1988 even, and you're subtracting 24 cents. Yes, it should be 76 cents. Okay? So
Okay.
therefore, year 3,
$1,033.76.
okay? What's my rate going to be?
40%.
40%.
Okay, that would be $413.51. 50 cents.
50 cents, good. What's my accumulated?
$1367.74.
Good. Bringing my book value to be
$620.26.
good. So then year 4,
It would be the book value of $620.26.
mm-hmm. So my depreciation expense is going to be
$248.10.
248.10. Good. Giving me a total accumulated depreciation of
$1,615.34.
84 cents. Good. 84 cents. So then therefore your book value should be
$372.16.
okay. So then the last year, 5th year.
Is $372.16.
Mm-hmm. So my depreciation expense is going to be
$148.86.
okay. Giving you a cumulated depreciation of
$1,764.70.
good. Giving you a book value at the end of year 5 to be excuse me.
$223.30.
Good. So, question. Can you go for a 6th year?
No,
Why? How old is your asset?
it's 5 years old.
Are you sure? What did you say in the very beginning of the year?
Okay,
How old is your asset in the very beginning of the year?
it was 4 months old.
And now that 5 years later passes by, or 5 years full, and this technically, if the first year was 4 months, and then 4 more years later passes by, how old is your asset?
Okay, we still hanging on with that extra 4 months.
Yes. So in this case, we still have 8 months left to go, right? Because if your asset's only 4 years and 4 months old, I still have 8 months left to use on this.
Right.
Okay? So in this case, yes, you can go for a year 6. Okay? Now, if you go ahead and process the year 6, what happens? Go ahead and do it. Go ahead and calculate my year 6.
Okay. Okay, it would be 89.32.
Okay? Giving me an accumulated depreciation of
$1,854.02.
good, bringing me a book value of
$133.98.
$133.98. Can that be possible?
Yes, because of the additional 4 months.
What's the number one rule that you have to always make sure?
Uh,
At the end of its life,
it has to have the salvage value.
what's my salvage value supposed to be?
2,500.
My
200.
200. Is my book value 200?
No.
So therefore, that means this isn't true. So therefore, I need to recalculate this, excuse me, to get me the answer I need to get. So in this case, I have to work backwards. Okay?
Right.
So that means I need to work backwards. So in this case, I need to figure out, right?
Right.
What it takes to get my salvage value to equal to my book value, right?
Right.
Okay. So in this case, that means it can't be this number. It has to equal 200, right?
Right.
Excuse me. So let's actually utilize math here. Okay? If we know this much information, we know that my formula to solve for book value, right? So I'm going to go ahead and type it in here. Book value is equal to, what's the formula? How do I solve for book value?
Hmm. Would the accumulated depreciation be 67?
How did you get 67?
What I did is that I subtract the previous book value from the actual salvage value.
No. Okay, well, still, let's go ahead and look back at this, okay? Your book value, okay? How do I determine my book value? What's my formula? How do I solve for book value?
I'm sorry, I didn't write that down.
Okay, so how do you solve for book value?
Okay, the cost of the assets minus the accumulated depreciation.
Mm-hmm. So in this case, that's exactly correct. So cost of asset minus AQ depreciation, right? You already
Right.
know what your book value should be, right? It should be $200, right?
Right.
My cost. Do I know the cost of my asset?
1,988.
So I just need to solve for X. Or in this case, yeah. Or I need to solve for A. How do I get to A?
So it would be 198 minus 1,988 minus 200, so that'd be 1788.
Good. So that's that one right there. How do I solve for my accumulated depreciation?
Okay, it would be the previous year accumulated depreciation plus the current year
Good.
depreciation expense.
So in this case, that is correct, right? AQ equals previous year's AQ plus current or expense, right?
Mm-hmm.
We know what my accumulated depreciation is, right? I just solved for it. It's 1788, right?
Uh-huh.
And if that is equal, right? What was my previous year? What was my previous year's accumulated depreciation?
Is it 1854?
No,
Oh,
we crossed that out.
is it zero?
No. Look at your chart. What did I solve for my accumulated depreciation for year 5? How much?
1788.80.
That's for the 6th year.
Okay.
What was my accumulated depreciation? How much depreciation did I rack up as of year 5?
1764.70.
1764.70, right? And I need to add my expense, right? So I'm going to put E. So how do I solve for that? If I know that much information, how do I solve for my depreciation expense?
Is it the 148.86?
No. Look at the equation down below here. So the accumulated depreciation is equal to previous year's accumulated plus my depreciation expense. If I already know that at the end of the 6th year, my accumulated depreciation is 1788, and my previous year was 1764.70, I need to add something to that number to get 1788. How do I get to 1788? Look at the formula. If I started out with 1764.70, how do I get to 1788? What number do I need to add to make it to 1788? Okay, let's try again. If you are at 1764.70, right? That's what you're starting out with. How do I get to 1788? What do I need to add in order to make 1764.70 equal to 1788?
Will it be the expense?
That's what I'm trying to solve right now, is what's my expense. If I started out with 1764.70, how much do I need to add to make it equal to 1788?
Is it 233?
No.
Could you pull down your screen a little bit? I'm trying to see. Okay, the expense.
That's what you're trying to solve for.
Okay, 148.86.
No. You're okay. Start again. You have 1764 right now. How much do I need to add to get to 1788? You have 1764 right now. How much do I need to add to get to 1788? Look at your equation down right here. Right now, I need to get to 1788. I have 1764. How do I get there? Is there something that you're confused about this equation?
Yeah.
Okay. Let's look at this equation one more time. Okay, this is the same exact equation. I'm currently at 1764 right now, right? And
Right.
70 cents. How much do I need to add? So that's what I'm looking for is E to get to 1788. That is what I'm solving for right now. I'm solving for what do I need to add to 1764 to equal 1788.
As the $24.
Yes. Or in this case, if you're using specific numbers, if you're using the 1764.70, right?
Right.
You need to add $23 and 30 cents to get
Okay.
to 1788. Okay? You can also look at this equation and say, well, I can take 1788 and subtract that 1764.70 to get the same exact answer.
Okay.
All right?
Right.
There's nothing confusing about this equation right here, right? I'm just asking you, how do you get from one number to another? In this case, I'm using the equation. I'm working backwards. Okay, I'm not working forwards. I can't work forwards because in this case, I need to figure out what this number is because I'm given that the end of the year, my book value should be equal to 200, right? I'm given this number. So that means I'm forced to work backwards, right? Now, if you were trying your hardest to work forward, right? The easiest way to figure this out is, well, if my book value at the end of year 5 was $223.30, right? How much do I need to depreciate in order to reach to book value? So if I'm currently at $223.30, I need to reach to 200 because that's my book, that's my salvage value, right? How much do I need to depreciate?
You would have to use the 1788 minus the from the 1988.
No. I'm asking you, look at the book value. Look at the book value. If on year 5, your book value was $223.30, right?
Right.
I need to get to 200. So how much do I need to depreciate?
The $23.
And that's exactly what you solved right here. You need to just only depreciate $23.30. In this case, this one's more easier to determine, okay? Because you're right? If I ended my book value at year 5 at $223.30, and I know for a fact at the end of year 6 I need to be at 200, what's the difference between the two? $23.30. That's how much I need to depreciate in order to get my book value to equal 200. Okay? All right. So, last two questions here is going to be question number 5 and question number 6. What is going to be the entry for the first year and the entry for the second year?
It's going to be depreciation expense
Depreciation expense. Good.
and accumulated depreciation.
Good. Okay. For how much for the first year?
265.07.
265.07.
And it's going to be the same for the accumulated depreciation.
Excuse me, guys. Okay. So what is it going to be for the second year? So same exact journal entry. What's the value for my second year?
Okay. It's 689.17.
689.17. Good. All right. Any questions?
Okay, I got that. I'm getting the hang of it.
Okay.
It's like, even though I act like I had to give a pony teeth.
It's okay. That's the purpose.
Mhm.
We're supposed to be learning. So in this case, now that we went through over this, we do have more examples of this. Not tomorrow, but the next day, right? Thursday, we do a chapter 11 review. So we will review this exact section, and then we have another one for the study guide. Okay? So at the end of the day, there's more and more problems, okay?
All right.
All right. So right now, we're going